Welcome to the Organized Investor PodCLASS with Jerry Goodman and Megan Hubbard from Tennessee Wealth Management. Think of these pod classes as a college of knowledge, and the curriculum is an inside look at how we work with our clients to organize their investments, their retirement, and their affairs. Our process is certainly not the only approach, but it has served our clients well. Listening may materially improve your life as well, but for that to happen, it also takes an open mind, an interest to learn, and your trust in what we're sharing. We focus only on what is relevant and will explain things several times in different ways over multiple classes to ensure you understand their importance. We suggest you subscribe so you'll receive reminders about the next class. And with the tools and information on our website, theorganizedinvestor.com, you can start getting organized right now.
Hi, class. Thanks for joining us today. We're going to be covering the topic of investing on today's podcast. And with this topic, our goal and our hope is to materially improve the financial lives of our clients. And to demonstrate that that's actually possible, we're going to share the average performance numbers of every client for whom we currently manage an advisory account for. Now, has your financial advisor ever shared the performance numbers for their clients? I doubt it, but we're actually going to share the performance of our clients on this podcast today, so you're going to want to listen in. I'm Megan Hubbard, along with my dad, Jerry Goodman, and students, thanks for showing up for PodClass number 11. This is actually our 5th PodClass in a series of PodClasses on organizing your investments. I want you to think of us as Megan and Dad. I'm a former first grade teacher at the Christian Academy of Knoxville, and Dad learned that first grade teachers who take roll every day are very absent-minded.
Absolutely. Yep.
I had to stick a teacher joke in there. I have a master's degree in curriculum and instruction, and Dad has over 40 years of stories, experiences, and most importantly, he would say, comments that he thinks are funny. At least he thinks they're funny.
Well, maybe funny. And Megan, in case you didn't know, you know there's an alcoholic beverage called a grasshopper?
I did not know this.
Well, it's probably because grasshoppers, they're known for being pretty heavy drinkers. Most people don't know that either. But anyway, so a grasshopper, he hops into a bar for the first time, and the bartender yells out, "Hey, we got a drink named after you." And the grasshopper looks back and goes, "That's kind of strange. You have a drink named Steve?"
Oh my God. Where do you get these jokes?
Just wherever. I can't really share my sources, but unfortunately, as you might expect, some of the jokes I tell here are not as funny as the ones that I can't tell here. So anyway, as Megan mentioned, this is PodClass 11. We thank you for joining us. And if this is the first time, welcome. Well, even if it's the second time, welcome. And we hope you're going to subscribe to future pod classes to be reminded to listen.
So these pod classes are the easiest and most convenient way to learn. But we also conduct live in-person workshops in the conference room center of our building, which is located in the Landmark Center building, which is at the Paper Mill Road exit in West Knoxville. Each of these events lasts about 2 hours, and we feed you a light meal, and it's offered without cost or obligation. The seating is limited in these events, so we do require reservations, and you can actually make those on the workshop page of our website, theorganizedinvestor.com. You can actually watch a short little video on that website as well. This will give you kind of a mini version of our workshop if you want to start there. Or you can just go ahead and sign up for the full version of our workshop that's live and in person. There are dates and times on our website. So make sure to reserve your seat.
Megan, you ever heard that expression, you must be present to win?
Absolutely, I have.
In this case, you must be present to eat.
Well, so yeah, that's
you got to show
a
up.
requirement.
Yeah, we can't give you anything to eat if you're not there. So before we get into talking about investing, have you also been procrastinating on the topic of estate planning documents? And if so, a lot of people do this. Don't deal with it. Take a listen to pod classes 4, 5, and 6, where we cover this topic that everyone loves to ignore. Now, you'll learn how we can save you about $1,000 by working with a local estate planning attorney that we work closely with. It'll be for a flat fee. versus working with an attorney on your own. And particularly in PodCLASS number 6, let us say, we're going to discuss in that PodCLASS an in-depth discussion about what we think to be a massive campaign of misinformation designed to convince people to use a revocable living trust, because for that industry, it's a much more complicated, but also more profitable solution than just using a will. So take a look at, listen to PodCLASS number 6 if you think you might want to do a revocable living trust. It's good information.
Then there's the topic of organizing your investments. And organizing your investments can be more financially beneficial than saving just $1,000 on the estate planning documents. And so we begin talking about this in PodCLASS number 7, and it's turned into a series that also includes 8, 9, and 10. And I know my dad is dying to tell his joke.
Oh, it's the 7, 8, wise 5, afraid of 6 is because
7, 8, 9. We've told this joke before.
We only told the grasshopper joke once, though.
No, the 7, 8, 9 joke, you can't honestly not tell it when you say the numbers in consecutive order. So anyways, so we are past 7, 8, 9, and 10 actually, and we are now up to number 11, which is where you are today. And why we are so excited about the PodCLASS today is because we're going to be sharing information with you in its actual net performance numbers for all 190 advisory accounts we manage for our clients. And knowing what our clients have experienced, and that's going to help you determine if your portfolio has room to materially improve.
So our goal is to improve someone's overall performance by at least 2% a year. And how is that possible? Well, by reducing advisory fees, investment costs, and also by improving the investment performance. And by focusing on stocks from what we use called a DSIP list, which is a very profitable, then very successful Wells Fargo research list, that's what we do. And it has a 30-year track record of 12% per year.
Now, the net rates of return for the advisory accounts we manage are after any fees or costs. So just want to make sure you understand that, after fees and costs. So it's what the client actually realized as their returns. And this is actually through the end of January 2024. So we're going to be talking about every one of these 190 accounts. Haha, just kidding. You probably hit the end button after I said that. We are not, but we are going to give you some performance averages of these 190 accounts as a group, okay? Because that's more, valuable with your time than talking about each individual account. And our suggestion to you is to simply compare the rates of return of our advisory clients to the track record of your own portfolio.
We're glad you're able to join us, and we think you're lucky to get to hear all of this. And as we often say, speaking of lucky, have you ever bought a Mega Millions lottery ticket, Megan?
No. Mom bought one for me one time, I think, but not me personally.
Well, I haven't, but most people have. And there was a ticket purchased at a Publix grocery store in Jacksonville, Florida. It was August of 2023, and it had the winning numbers, and it was worth $36 million, which is a bunch of money.
Yeah, that is a lot of money. Now, granted, this was before the income taxes would have been taken out, right? So, but even after taxes, that's still $20 million. That's a whole lot of money. And the odds of winning a Mega Million jackpot, I wondered about this. So looked it up. It's actually a 1 chance in over 302 million.
Wow.
1 in 302 million. So you're saying there's a chance.
Yeah, there is a chance, a baby chance. So this person, they had purchased the winning ticket, but Florida law requires they have to claim that jackpot within 180 days, or guess what? They don't get the prize. It gets forfeited. Now, since we're telling you this story, you may have kind of figured out that as of mid-February 2024, the prize is unclaimed. And so the $36 million, it gets transferred back to the Educational Trust Fund in Florida and also the lottery prize pool. How fun.
No.
Oh, yes. And now, whenever you hear stories like this, my first reaction is, God, what an idiot, or what a stupid person to do something like that. But I mean, let's be honest about this. The fact is, the person didn't know they had the winning ticket. Otherwise, they would have claimed the prize, right?
I mean, maybe they lost the ticket. I could see you losing a winning lottery ticket on the piles of stuff on your desk.
Well, that's yeah, possible.
I mean, maybe they threw it in a drawer and they forgot about it. I mean, whatever the reason, they wouldn't forfeit the prize on purpose, right? So obviously they just didn't know. And this is not the first time, actually, that a really large lottery ticket has gone unclaimed, which is so sad to me. So here's a person that was lucky enough to have the winning ticket, but they were not lucky enough to realize it.
So, Megan, if that were you, you found a ticket, say, after the prize had been forfeited, would you even want to know that?
Absolutely not. That'd be so sad. I would not
Yeah.
sleep.
Well, I mean, I would think something like that could haunt you. I mean, how embarrassing. What would your friends be doing to you? In terms of you're the person that didn't cash in the ticket, you dingbat.
I mean, I know Meredith and I would, that's my sister for listeners. We would never let you forget it if you did this, Dad.
Well, back in the 70s, there was this TV show that Lee Majors was in. It was called $6 Million Man. So I guess you all would be probably calling me the $36 million loser.
100% we would be. So, here's the takeaway from this missed opportunity story that we've said before, and we're going to say it again. Think of your portfolio as a lottery ticket that you already own. And, these pod classes will help you know if your portfolio has the winning number. And in fact, whenever you see a TV ad or a billboard, about the lottery, maybe you're driving down the interstate and there's one in your state, or in Tennessee, if you're here with us in the beautiful state of Tennessee, think about your investments. Don't think about getting off the interstate and buying a lottery ticket, because remember, your chances are 1 in 302 million. Think about your investment portfolio, and have you checked in on that lately? At this point, does your portfolio have room for improvement? That should be the question you're asking yourselves anytime you see a lottery ad.
So going forward, every time, as Megan mentioned, you see a commercial or a billboard with a lottery, you need to think about, gosh, what about my investments? Now, this may sound a little wacky, but folks, I'm going to tell you, this lottery ticket, it is the perfect metaphor for what we're trying to explain. Okay, it's perfect, because if you buy a lottery ticket, how do you know if it's a winner? I mean, you don't just buy the ticket and throw it in the door like maybe this person did. Well, you got to check. And if you want to know if your portfolio has a winning number because it has room for improvement, well, guess what? You also have to check.
Exactly. And you know what? Even though your portfolio doesn't have an expiration date like the lottery ticket does, the sooner you find out, the better off you're going to be. That's just more time for more improvement. And if you never find out, you're just going to miss out completely. So you're going to ultimately be like the person in Florida that missed out on 36 million, not $300, $36 million. So obviously you don't want to be that person in Florida, right? Like, if you miss out on an opportunity like that, you're never going to get over that. So we're making every effort to help you find out if you are the person that has the opportunity to improve your portfolio. And we're sharing ideas of how you can even, check yourself. And we're also there to help you along the way to do this. And if you have questions along the way, we are always findable or reachable, whatever the word might be.
Locatable, as long as we're making up
Locatable.
words. So in earlier pod classes, we've discussed in depth how we focus on stocks from what's called a DSIP list. It stands for Diversified Stock Income Plan, which is a mouthful, but this is a research list from Wells Fargo. It's averaged 12% a year for the last 30 years. It focuses on stocks that have a history of raising their dividends. Okay, it's been incredibly successful kind of thing for our clients. Now, we've also explained many times that our goal of organizing your investments, that is to improve your overall performance by 2% a year. So if you happen to have, let's say for simplicity, $1 million portfolio, that's equivalent to $20,000 per year, $20,000, or $400,000 if you'll just extrapolate that in simple math over a 20-year period. So the possible benefit to your portfolio, it's not going to be as much as $36 million, granted, but it can involve a lot of money, and your odds are certainly a lot better of having some benefit than 1 in 302 million, aren't they?
Yeah, I'd say so. So in case you're wondering just how much better are the odds, the answer is, it really doesn't matter. It doesn't matter about the odds, because what we're talking about here is a portfolio of investments that you already own, right? You already have essentially the winning lottery ticket, if we're going to use that metaphor. So, in other words, there's no downside to doing a little investigating and making a few comparisons, and assuming you're willing to spend a little bit of your time to do that. Now, if you're not willing to spend a few minutes to think about your investments compared to what else is out there, I'm not sure that listening to any of this is really going to be much benefit to you. Maybe will help you go to sleep. I don't know. But
Well, if the entertainment value of listening to us, Megan, you can't put a
oh
price
yeah,
on that.
well, there are the jokes. I mean, I
Well,
forget.
yeah, it's so memorable. So this person in Florida, again, they already had a lottery ticket. It was up to them to find out if it had the winning number, and they didn't. And now it's too late. And now you have some sort of if you have some sort of investment portfolio, it's up to you to find out if your investments have a winning number that may materially improve your financial future. It's up to you.
So you're probably thinking, okay, well, if it's up to me, how do I find out if I've got the winning number? How do I find out about, do I need to improve my investment portfolio? Well, you can call your financial advisor, which is probably the last thing you'd want to do because they're probably the person who set up your portfolio in the first place, right? So they're not
Yep.
going to probably send you down a different path from what they've set you on. You could also ask a friend if you don't mind them knowing your business, and they could help you sort through, the investments that you currently have and what else is out there. You can also try to find out by yourself, which is great. And some people can do this, but it's also overwhelming. And it's good to have other sets of eyes on things and have different opinions about things, right? Or you can find out yourself with us helping you along the way. Again, I've told you we're findable, locatable, searchable, relatable. I don't know. I like putting a bull on the end of things. And you know what? We're happy to help you at no cost or obligation. But that's the thing. You're going to have to get in touch with us. We obviously don't have your phone number. So,
Can you explain how your financial advisor manages your investments? Do you have enough money saved for retirement? Is your advisor making more money from your accounts than you are? You're climbing the learning curve by listening to this Organized Investor PodCLASS with Megan Hubbard and her favorite CFP dad, Jerry Goodman. It's best to listen to a number of their PodCLASSes to help you understand how they work with their clients. At that point, you may decide to have a chat with them to see if working together would make sense. So thanks for listening.
So it's very common. And you may say, well, I don't pay much attention to all of this investment stuff. That's what my financial advisor is there for. But let me remind you, these are your investments. It's your financial future we're talking about here. And don't you think you need to know a few things? And we'll also need to know a few things if we're helping you. So let's go through the actual performance numbers for these 190, or give you the average of these 190 advisory accounts that we manage and we've been giving you the preview for.
So the 1-year average, the collective return for these accounts that we've managed for at least a year was 11.56%, and that's through January 31st of 2024. Now, to be clear, for all 190 accounts we manage, there were 171 that had been in existence for at least a year. And that 11.56% rate of return, that's a net return over the last 12 months, which means it was after any advisory fee or cost had hit.
So we're going to go through each of these pretty quickly. The 3-year rate of return is 9.99%. You could round it up to 10%, but technically it's 9.99% per year net return for the 127 accounts that have been managed for at least 3 years. So again, 9.99%, and that is again after any kind of fees or investment costs or related expenses.
The 5-year rate of return is 14.06% per year, which is also net of any fees or costs for the 87 accounts that have been managed for at least 5 years.
The 10-year rate of return is 9.6% per year. That covers 35 accounts that have been managed for at least 10 years.
And finally, the last number is an average of all the rates of return since each account began being managed by us, and it's actually 11.48%. So this is called the rate of return since inception, which is the performance of the account since the date it began as an advisory account until the month end of January 2024. Now, this average rate of return since inception for all of the 190 accounts currently managed is 11.48% per year through the month end of January 2024. The average number of years since the inception date for all 190 accounts we manage is 5.9 years, with some being as long as 20 years of history and others which are only a few months.
So just to be clear about this rate of return since inception, it gives you a little historical perspective, but the starting dates for all 190 accounts may be different from the other accounts. And also it may be different from when your account began as well. And this makes it also difficult to try to compare that 11.48% return to your own portfolio.
Anyway, those are the net rates of returns our clients have experienced based on 1 year, 3 years, 5 years, 10 years, and since inception. And there's a lot of numbers here, right? So to help you remember this, we suggest you focus on the 5-year rate of return, which is short enough to include 84 total accounts and long enough to provide some historical perspective for you. Now, again, that 5-year rate of return, that covers 84 accounts, and that was 14.06% through the end of January 2024.
Also, these rates of return, they're obviously for informational purposes. Past performance is no guarantee of future results. And the returns for each of these accounts, they can vary based upon the client's individual circumstances, such as when they started the account, what the investment objective was, those sorts of things. Did they take money in and out of the account? These rates of return were also compiled from month-end performance reports for each of those 190 accounts, respectively. And it's way too much information to try to place on our website in any sort of understandable manner.
So, in addition to covering the summary information with you here, we are absolutely happy to share all of this in either a face-to-face meeting at our office or maybe even on a Zoom call if you prefer that and that's more convenient for you. So, in other words, we have a lot of boring documentation to back up all of these statistics. Okay. We promise we are happy to give it to you. And we are happy to cover it with anybody brave enough to go through it with us. This is a lot to hear.
It's an earful. So again, I think what Megan said, keeping up with the 5-year number, 14.06% is one number in your brain. You can compare that to anything. You can probably remember one number. So that is what our clients have experienced with the approach that we take. And here's a few clues to look for, much of which should be on your statements if you're trying to figure out, well, what have my returns been? So look at your statements and the reports that you have been sent. First, do you have an advisory account? And the answer is probably yes, if you're being charged a periodic fee based upon the size of that account.
Second, do your investments include a large number of either mutual funds or exchange traded funds? So these types of investments, they probably have had mediocre performance because they have high investment costs and or they may over diversify the account. Actually, we call that diversification.
Dun, dun, dun.
Well, we always add a sound effect. Both of these, though, can hurt performance in a really significant way.
And third, and this is very, very important, maybe I should say very, very, very important. Do you know what your investment performance has been for the last 5 years? Okay, again, it may be on your statement, maybe a performance report that you've received. The 87 advisory accounts that we manage that have that 5-year track record of, let's say, 14% net rate of return, that was mathematically equates to a 92% increase in value over a 5-year period.
So 92% is not a double in value, but it is so close. And it's the net rate after any fees and costs. Okay. So it's best to know your 5-year rate of return. But if you don't, here's a question you should know. Did your portfolio come even close to doubling in value over the last 5 years?
So if you need help, you can do a couple things. You can upload your statements to us. We have a secure share file link on our website. You can upload them to us. They come to us, and we'll be happy to look at them and discuss them with you. Or you could bring them in, and we could talk about it face to face. And once you understand how your investments have been managed and know what the rates of return have been, you're going to be in a much better position to know if you have some room for improvement. Do you have possibly that potential winning lottery ticket that you could potentially improve in a significant way your financial future?
So in podcast number 8, we discuss a mutual fund advisory account called FundSource, and that's available through our clearing firm. We have a summary of its performance on the investments page of our website, and the rates of return are before any advisory fee has been deducted, okay? But our rates of return are net after all fees and expenses, and it makes sense to deduct an assumed 1% advisory fee from the fund source returns to make this a fair comparison when you're looking at these side by side.
So we're sharing the track record for the aggressive growth model of FundSource, and the 3-year track record after assuming a 1% advisory fee. That 3-year track record after the fee is 2.47% per year, versus our 3-year net return of 9.99% per year, which is basically 3% more, 300% more than FundSource.
So the 5-year track record of FundSource, assuming a 1% advisory fee, is 8.92% per year versus our 5-year net return of 14.06%, which is 57% more. Now, the 10-year track record of FundSource, after assuming, again, that 1% advisory fee, is 5.78% per year versus our 10-year net return of 9.6%, which is 66% more.
Massive numbers differences there. So keep in mind that FundSource and even this DSIP list strategy that we focus on for our clients, again, for the 400th time, past performance is obviously no guarantee of future results. And this FundSource returns that we're giving you, those are through December of 2023, and returns we're sharing with you were through January 2024, which is basically a month later.
So maybe you're thinking, why the large differences in the FundSource returns versus what we do, what we're having our clients invest in? Well, part of it's because of the FundSource strategy, and it's invested in mutual funds with a hefty internal cost of about 0.79%, which we're avoiding by owning individual stocks for our clients. For someone with $1 million in this FundSource model, that's equivalent to $7,800 per year in cost. Okay. That's like a trip somewhere really nice, like to the Bahamas or something. Also, FundSource owns 14 different mutual funds, which means it owns several thousand companies versus our more selective approach of focusing on high quality companies with a history of raising their dividends.
So those are some very significant differences in the returns of what our clients have experienced versus this FundSource example. And you would have been far better off with a strategy based upon that DSIP list. In fact, these are the types of opportunities that we would say you can drive a truck through this, and why we feel you're actually lucky to be listening to this explanation.
Now, in case you're invested in a similar approach as this FundSource mutual fund model with the same type of underperformance, you're that person we've been referring to. Your portfolio may have the winning number because your overall performance improvement may be even higher than the 2% goal we've even referred to.
Exactly. And if you happen to be invested in something similar that has a better return than, say, FundSource, well, congratulations. But the examples that we're sharing with you here, those are similar to what people will usually show us when they send us information.
So will the DSIP list always be a better strategy? Well, who knows? We can't exactly answer that, right? But we know right now that we feel it's the best strategy for our clients. And you know what your financial advisor is recommending because you're already invested in it.
For these accounts, the performance is not the only story to share here. And in future pod classes, we'll be explaining more about how we actively manage these accounts to try to minimize the risk, to try to lower the volatility so that the accounts don't change up and down in value quite so much. For example, this 5-year track record was not made by investing in some small number of technology stocks. And it was not 100% invested in the stock market for that entire period. In fact, as of early March 2024, we've transitioned most every advisory account to a much more conservative allocation of 48% in stocks and much of the remainder in like a money market funds paying over 5% interest. So there was no incremental cost to make a change like this. And these accounts now have much less risk. We have a lot of available cash that we plan to reinvest during some market downturn, whatever that may be.
So, in this podcast, we've made a 180-degree shift in how we're now explaining all of this. Previously, we would have said, or we were saying, what if you saved 0.25% on your advisory fees? How much would that help you? And what if you saved another 0.75% in mutual fund costs? And what if you improved your actual investment performance by 1% per year by being more selective with your choices? Basically, what if you could improve your overall performance by that 2% per year? And based on the value of your investments, how much would your long-term benefit be? Well, that's a lot of what ifing. So we decided to explain this from the other direction, which is why we took the time to compile the historical rates of return for all the advisory accounts we manage.
So in reference to what Megan's saying, that 14% net rate of return for the 5-year period, let's talk about that. That already reflects our lower than usual advisory fee. It already reflects the fact that we try to avoid mutual funds to not only reduce the cost, but improve the performance. It also reflects the fact that we're selective with our investment choices and focus on stocks with a history of raising their dividends because of the exceptional returns for this group of stocks. So this is what those 84 stocks have experienced over that 5-year period. So this is what is possible with our process.
So what does a 14% net return mean over a 5-year period? And would that materially change someone's financial future? Well, let's assume someone had $1 million invested over a 5-year period at 14% per year. And you ignored the income taxes to keep it simple. And, what would it be worth at that point? Well, with the compounding, the $1 million would have grown 92.5% and would be at $1,925,000. That's literally $75,000 less from doubling your money. Okay. Like technically doubling your money. I'm going to call this, though, pretty much you've doubled your money, right? So in this made up example, did a client who on average realized a 14% annual return for those 5 years, did they materially improve their financial future? I mean, I don't think I could find anybody that would say no. The answer is yes, right?
Exactly. And compare that to whatever you want, okay? But if you took that same example, and let's just assume the rate of return was 7% instead of 14, the ending value would be $525,000 less. Okay, it's a big number. Now, most people, as Megan mentioned, most people would consider almost doubling their account value in 5 years, being up about 92%. Would they feel like they kind of maybe didn't win the lottery, but they kind of felt like it because they had a material improvement in their financial future? And sure, it's not worth $36 million, but it's still a lot of money. It's still a lot higher probability. And by reducing the fees and the expenses, and also by simply being more selective with the investment choices in that portfolio that they already own.
Right. So, even though the actual performance our clients have experienced is no guarantee of returns, right? Future returns, it certainly provides insight as to what's possible because we've seen this be possible with our clients. And hopefully this is a wake-up call to see if your own portfolio has some upside potential and, just how much that might be.
Now, one more thing to just keep in the back of your mind. What percentage of people that we meet with have, say, one orphaned account somewhere that they don't do much of anything with, okay? I would say it's about half of everybody. Now, it can be that retirement account at a company where you worked at a zillion years ago, or maybe it's just some small account somewhere that's been ignored and it needs some loving. But even though the average size of our client households is in the hundreds of thousands of dollars, the minimum account size for us to manage an account like this can be as little as $50,000.
So if the performance of that neglected account has been less than great, we can actually explain how to bring it under our management so that we can hopefully make it great, right? Is it difficult to do that? Well, the process to transfer an account is actually very simple, and this will also give you a chance to experience firsthand what we do and how we can help you.
So to wrap things up, we've explained how we use what are called the dividend growth portfolios, the benefits of being selective with your investment choices, and how, again, you may be able to materially improve your long-term financial future. And what our advisory clients have experienced in terms of return. So again, as of January of 2024, we had 190 advisory accounts. 84 of them had a track record. Actually, it's 87. 87 had a track record of at least 5 years with a net rate of return of 14% per year.
So, what are you supposed to do with all this info? Because we've given you a lot of information, right? For starters, just compare it with the returns of your own investments and, ponder the long-term potential benefit that may exist for you. We'd also invite you to have a discussion with us to review your situation just to see how much all of this may be able to benefit you. And another option is to upload your information to the secure Citrix share file link that's on our website. And, we can discuss this with you over the phone on how to go through that process if you would like to do that. You can also just drop your statements by our office, and we're happy to look at them that way. But we do suggest that you get a second opinion about what your investment portfolio is currently doing.
We also, once again, want to invite you to join us for one of our live in-person and fun in-person workshops. These are in the conference center of our building, Landmark Center, which is at the Paper Mill Road exit in West Knoxville. There's actually an Exxon station at that exit, and we're in the big office complex behind the Exxon station. On the workshop page of our website, which is the organizedinvestor.com. You can see the dates and times, watch a video that Megan did a great job with, even reserve a seat. And as we said earlier, you must be present to eat, because we do try to have a light meal to give you something to look forward to other than just talking to us.
Well, and you also have to be present to hear all of the jokes that you could be missing out on that you don't know or have not heard before. I know that right there is a reason to reserve your spot today.
You don't want to scare them away, Megan.
True. Forget that. We're not telling any jokes.
No jokes.
So, was this a lot of information to digest? Yes, absolutely. I could see where, as the listener on the other side of this podcast player, you are thinking, oh my goodness, you've just told me so much. And are we through with all of the information? No, we're not. We've got about 10 more seconds, so hang on. But congratulations for making it this far. And we would just say, please contact us with any questions that you may have. Remember, we're searchable, obtainable, findable, locatable, all the things. Also, be sure to follow us on social media, YouTube, LinkedIn, and save us to your favorite podcast player to receive reminders of the future episodes that we're going to release. We have more to share, guys. We really do. And this means that you have more to learn. So we would just ask that you join us next time and just expand your knowledge a little further. And as always, thanks for listening, and class is dismissed.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of the Organized Investor or TN Wealth Management. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional investing advice. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning or before making any investment decision. And please consult legal or tax professionals for specific information regarding your individual situation. The Organized Investor cannot accept trade or account instructions on or through this platform. Please contact us directly at contactus@tnwealthmanagement.com or 865-415-2060 to place a trade or for trade or account-related questions. Brokerage and advisory services are provided by TN Wealth Management through Prospera Financial Services, Inc., member FINRA SIPC. The Organized Investor is a brand name operated by TN Wealth Management for educational platform purposes.